Rohr here with an early global view on Tuesday, November 11th, 2014. It's currently just a bit after 7 a.m. U.S. Central Time, and it's a bit of subdued influences today because a good part of Europe as well as the U.S. is closed for the Armistice Day and Veterans Day holidays. That said, there are some important macro factors that are tending to keep the equities firm along with the dollar and weighing just a bit on the govies. And we'll be getting back to the rest of those later. Now, what does all this mean to the markets? Well, it means since last week, when the other factor that we did not mention right now was the ECB's more aggressive commitment to quantitative easing. That goes back to last Thursday, and that's when we ultimately saw the playing around in the morning, but ultimately this firm push up that by the end of the day left the market fully $10 higher up at 2028. And that was very important because it meant it had overrun the old 2012.50 December trading high from back in September that had been playing around with previous, but finally escaped confidently last Thursday. And of course that negated the higher of the two recent attempted failures, and that was the 2007.50. And of course these sort of levels, anywhere back down in the low 2000 area, 2013 down to 2007, are reinforced as support before you even get back to the gaps. There were dual directional gaps later on in September, gapping below 2000, and of course coming in on the major BOJ expansion of QE back 2 weeks ago on Friday, causing the U.S. markets to gap above 2000. So there's plenty of support below the market. And the question is, well, does this mean it just feeds on itself up to the higher resistance that's up at 2050 on the weekly oscillator to 2060 on the weekly chart topping line? And we shall see, but one of the factors is whether we get a little more heat in the near-term uptrend, get it to really start to push up more aggressively once again in a way that puts this short-term MACD, the hourly MACD, back out above its upper runaway band. Currently, it's dipped just a bit below it. It doesn't mean the market has to trend down, but it's a sign how much the market is just churning its way grudgingly higher for now. And certainly, if it should get back out above this, we would expect 2050 to 2060 to probably be seen in very short order, given the market's already up for today at 2038, so it's not that far away. And looking over all of this, we have to say that's pretty much it for the short-term view of the S&P 500.